to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Always a great day when Intro Man plays a part. So thank you for that excellent performance once again, Intro Man. I'm joined by two less frequent guests, I suppose. Patrick, you're becoming a frequent guest at this point, but we're joined by Patrick with Part-Time Investing YouTube channel, and then the return of Mike Sharp of Sharp Investing. So welcome to both of you guys, and definitely looking forward to getting into this Best Ideas episode. Since it's been a while since we did one of those, probably a bit overdue. But that's kind of what we're going to be diving in, try to give our best ideas. And I always have to give the caveat that best does not necessarily mean good. It could be the best of the worst, but we're going to try to find some potentially interesting ideas, talk about them. And, if you'd like to do further research on those ideas, by all means do it, since we're not necessarily recommending that you go for any of these stocks, but we're just trying to jog some ideas and see what's out there right now. So with that said, before we get into those best ideas, definitely check out all the great stuff in the description below. We have our links to ShareSite and Seeking Alpha. You can get some discounts there. And you can sign up for free versions as well using our link. And if you ever switch to a premium version, you can get that discount. So please look into that. That would go a long way towards helping the channel. And check out our Discord as well. Mike, I know you've been a long-time Discord contributor for us. So that's kind of where we initially met there. So it's a nice little group in there. So check that out. And like, comment, subscribe. As always, if you haven't already, if you've been coming to all these episodes, we're approaching episode number 100. As our friend Eunice in the chat has pointed out, we are getting very close, so that's exciting. And we just crossed 4,000 subscribers on YouTube, so that's very exciting as well. So making good progress here on the Punch Card channel, and we've got some interesting things in the works as well for more content here on the channel, with more personalities and contributors coming in to help us to improve our content and create totally new content as well, beyond just this live show, or if you're listening to this after the fact, this sort of live recorded show. So stay tuned for that. Subscribe so you don't miss any of that. And with that said, let's get into these best ideas, guys. First off, how you guys doing? It's been a couple of weeks since we've had an episode. Patrick, I think it's been a few weeks since you've been on, and Mike, I don't know when the last time you were on, but do you remember when that last one was, Mike?
Oh, I know it was a summer sub, so I think it was last summer.
Approaching a year then. Yeah,
oh,
I think you're on for yeah, you're a little delayed on the audio, Mike. So it must the audio and is back in that last year, so it needs a year to catch up or something like that. I don't know. So, but yeah, but we do hear you. Yeah, Patrick, how are you?
I'm good. Disclaimer, I am actually on call for my job, like right now this weekend, so I might have to, take a phone call or something, but that doesn't happen. Yeah.
Very important business. Okay. Good to know.
Yeah. Shouldn't happen though. Low chance, but since we're doing the podcast, it's more likely, I figure. Yeah.
Right. When the stars align. Well, maybe we just rip the Band-Aid off, Patrick. I don't know if you have a best idea you'd like to pitch to us. We can kind of get into that to start, and see what we're working with.
So like I told y'all, I have my best that's been a winner, and the best that I think will be a future winner, but is a current not so much a winner, right? So I'll start with the winner first. I think I've done many videos on them. Atkore, they are a just high level. It's an American industrial company that makes pieces and parts for electrical, I guess, infrastructure. And they're really seeing a boom with all the increased spending for capital projects and stuff in the US. And that's kind of the general thesis. But then whenever you dive into the company itself, low debt, growing free cash flow, and then really good capital allocation where, the repurchases are just pretty crazy. And they've made it clear that I just love whenever I hear management say something like, we're repurchasing shares because it is the best thing we can do with our money right now because it's so discounted. That's like music to my ears, right?
What's
And,
that ticker?
ATKR. Now, I am in at a much lower cost basis than it currently is, but the reason it's pretty much the only stock I have that I think I would truly, if I woke up and saw it was down 50% or something, I think I'd be happy. And that because I'd get to, it's already my biggest or close to my biggest position. And I think I would easily double it or so if that was the case.
Okay, so you're at about a 6 billion market cap as of today.
Yeah.
You mentioned the repurchases. Seeing the where's total shares outstanding?
So yeah, you're looking at yearly.
Yeah, here's the yearly chart. You can see the obvious progression down.
Yeah.
From about 64 million almost shares in 2017 all the way down to 39 or almost 40 million shares as of
this
September
one
of last year.
Yeah, and this one was also found with the magic formula. It's about a year or so ago, more than a year. But that's I think it's important to have one at least screener or filter before you just before you adopt a stock, and having something like the magic formula is I've had a lot of success using that as like a preliminary screener for my positions.
Yeah, it's a good place to source some ideas potentially, just for cheapness at least. So what drew you to this one? Because this is definitely what we would call a boring business. It sounds like.
Oh yeah, no, super boring. So
Yeah.
I magic formula. It was actually I think originally a recommendation on the channel, and I love boring businesses. Like how should I say this? I work in chemical manufacturing, so I'm familiar with the manufacturing business, and this isn't chemicals, but it's manufacturing pieces and parts, and also I think I tend towards stocks that have products that are needed and not necessarily going to be getting replaced because of crazy innovation or something like that. Like it feels nice to have you're making building blocks that's going to be used for future infrastructure and all that. Like that there's that line about the best person to be during the gold rush was the one selling the picks and shovels.
Sure.
And I think with the expansion, with the build back better, inflation reduction, and then just in general the AI, all the electric car boom, all of that. I think that the electrical infrastructure is going to continue to grow, and it's nice to have somebody that's going to have a hand in that, but not necessarily be competitive on the innovation side.
I think that's a decent way to put it. I mean, they do, according to their description, metal framing, mechanical pipe, perimeter security, and cable management. So, a lot of that electrical stuff that would be used in electrification across the board.
Well, yeah, they have two big sectors. They have the electrical sector, and then they have the safety and infrastructure.
Got it. So that's a perimeter security. Yeah.
Let me see. I might pull up there.
Conduits, cables, and installation accessories. Headquartered in Illinois, my former state. Founded in 1959, so they've been around.
They've been around, but they've recently, I think they've recently gone public though. If it's not. So you just since then it's just been with I don't know if it's new CEO or something, but the growth, the share buybacks, that sort of thing has just been really strong. And I mean, a given for me is anything is going to have low debt and low chance of going under in a down cycle. And so like, and that's also going to be included if it's a magic formula stock. But I'm
seeing the 760 million in long-term debt. Got Compare that to about $350 million in cash, and that's on what we said, a $6 billion market cap. So certainly manageable, at least on the totals. I don't know what the terms are, but that debt has been coming down in the last few years.
Mm-hmm. And just, yeah, like I said, the financing. And then I know this is nitpicky, but I talked about it at the last time I was on. But they have, if a company's going to return value to the shareholders, that they have two choices. You can do dividends or you can do, repurchases. And they're one for one if you think about it like that. But if the stock's discounted, obviously it's better to do share repurchases. So I much prefer if the company's going to be doing repurchases, just because, to me, that's also a signal that the stock's undervalued,
Yeah. I mean, well, for some companies, it's a signal that it's undervalued.
Yeah. You're right.
Others,
Some of them,
and others, you could argue,
pull up an example of one that Sleep Number, we talked about it. They were buying back shares whenever they were like over $100 a share buying back shares, and then it dropped to 20, and the repurchases just disappeared.
Yeah, you could argue that for a lot of companies, it's the opposite as the stock runs up.
Mm-hmm.
I mean, you see that across the broader market. Buybacks go up as the market is higher.
Well,
it could be a chicken and an egg thing, though, too. Buybacks will push up stock prices, and
but I think that this company has been pretty transparent with, there was an earnings call where somebody asked a question like, "Hey, do you see yourself doing dividends, any time in the future?" And the CEO or CF, whoever answered the question from the management, was like, he kind of laughed at it. And he's like, "Look, we got to get to at least a 10 PE before we even think of any type of other, capital allocation." So that.
I feel like it's a question on every earnings call. When are you going to send us cash in the mail? That's always a question. Doesn't matter who it is.
And the answers are usually very convoluted back. So it's nice to
Patrick.
hear something that's. Yeah.
Hey, do you mind if I ask you a question about this? Just wave at me. The connection is terrible. So I'm looking at the history of the revenue. So was there a change that happened sort of around 2020? Because I see the revenue was sort of slow growth, flattish for about 7 years, and then when 2021 hit, it really started to take off. Did something significant happen?
I would say that's been the boom of the U.S. industrial. You had the supply chain restrictions and stuff from China. I think a lot of people started wanting to source things domestically, and almost all their sales are domestically. So I think that you saw that was the big driver there, and it continues to be. I mean, if you look at spending for new, industrial spending in the U.S. has just been ramping up like never before. Since World War II era. So it's post-COVID.
Yeah, right. So,
there's many reasons for that.
The onshoring boom, I guess. Oh, sorry. I was saying it's the onshoring sort of boom, I guess.
Yeah, I mean, that would be. I think that the risk here is that it really is just a spike, and that you're not going to see, this be sustainable. And if you own it, what you're betting on is the opposite. But I would say that's the biggest
is that
risk.
potentially why it's priced the way it is? People
I think so.
A decline.
Yeah, I mean, I think, and I'll talk about this more whenever I get to my other one, but in general, industrials and commodity stocks they've been at really low PEs for a while now. And I think it's, there's actually in Poor Charlie's Almanac, he talks about, he talks about those stocks, and he says, I think a lot of people with commodity stocks they're like Mark Twain's cat that, it sat on a hot stove, and after sitting on the hot stove once, it never sat on the hot stove again, but the cat never sat on the cold stove either. So I think a lot of people have been burned by commodities, especially in 2008 and stuff. and so they're very cautious to get back into it. But I think that the game has changed. I think that you see that with Buffett's purchase of Oxy and all that as well. And I'll get into that with the other idea, but just the capital allocation is much different, and there's less growth projects and more returning value to shareholders. So you're not going to have that same cure to high commodities as high commodities, if that makes sense.
Yeah, right. Now, I see this comment from Tony in the chat. He says that insiders own less than 1%. Is that a concern?
I prefer to have insiders own more, right? But like if I could take my pick, but it's obviously something that I look at for stocks, and like it's on my list of that this would be great to have, but it's down the list pretty significantly. I would say below all the other metrics. And okay, I should say this: if they're repurchasing shares, to me that's a sign that they think it's undervalued. Either management itself could be buying back shares, or they could personally be buying shares. I'm fine with either one. And the stock's been up. I've talked about this before, but I think that there were some insider sells at the last peak, and in general, that doesn't bother me as much because people can sell stocks for many different reasons. Like they could need money for something else. There's a million other ways why somebody would sell a stock, but they really only buy it for one reason. And,
right.
And I don't want to spend too much time on Atkore because, like I said, part of me wants it to go down because I really would add more if I was able to get back in at my close to my original basis, or even a little bit up from my original basis. But
I'd be most curious in where revenues, cash flows, everything would return to if they come down at all. If I had to guess. I would assume there'd be some reversion to the mean, and let's see how far out we can go. Yeah. So that there was a dip during the, 08 to 2012-ish crash. Cash flow went negative. It seemed to kind of plateau around 100 million a year. And in 2021 shot up to $500 million, and 2022 was at 650 million. So a large, quick increase, and you wonder where the new average will be.
Yeah, and I'm a little confused. I know that they went public, I think, around 2016. So I'm kind of maybe they just had the historical data.
Yeah, I think they still have to disclose at least some of it, but I don't know. When they go public, but or maybe if I go to the all-time chart, it looks like it was 2016 when I think you're saying they went public. But we have, according to this, I don't know if this is different at all than since 2016, but either way, the theme of it kind of being around 100 million and then shooting way up is definitely clear.
Yeah.
But okay. Anything else then on Atkore? It's a classic boring business. So
yeah, no, just magic formula, growing cash, lots of share repurchases. That's how I'd sum it up. Yeah.
Okay.
So let's hear yours.
Sure. Well, did you want to do your other one as well, or should we get back to that?
I feel like I've been talking too much.
All right, fine. Mike will rejoin us in just a second. He's switching rooms because of internet issues, as you might have noticed on the live stream. So he'll be back in a moment. But the idea I wanted to talk about, I've done. This is more of a. At least my initial thesis would be more. It would be more on the founder. Sorry, I'm trying to pull up the ticker, and that's Tiny. The company itself is called Tiny, and this is an Andrew Wilkinson company. He, for those of you who don't know, he's kind of like I hate this sort of title, but he's known kind of as like the Warren Buffett in kind of the software sort of space. And I actually, think that title is like decently appropriate, just in the principles that he espouses. They're very Buffett Munger-esque. They actually recently put out their like a full annual meeting, and it kind of mirrored some of the Buffett Munger Q&A style that they did. It's a $500 million company. Pulling up the ticker now. It's traded in Canada, but they recently, they just went public because Tiny is like a fund that Andrew Wilkinson runs that owns a bunch of companies, both a mix of minority and majority ownerships in businesses. And then they recently merged with WeCommerce, which does like Shopify and like e-commerce plugins and those sorts of things. They merged with that and just very recently went public, and they relisted as Tiny, but you might see the ticker as WeCommerce and Tiny. But anyways, I have a few questions on the actual structure here, because Tiny itself is an investment fund, and then that merged with WeCommerce. So I'm not really sure what sort of obligations the fund has versus WeCommerce. So I'm not really too sure on that. But I think there's something interesting here just with ownership that I'd want to look a lot more into, just because of Andrew Wilkinson at the helm. He's very outspoken and seems very principled. He's very consistent in his messaging. I listened to the My First Million podcast quite a bit. I would recommend it. And he comes on there quite a bit talking about what he's looking at, different business ideas and that sort of stuff. So very interesting guy and potentially an interesting company. Here's kind of their company page I was looking at earlier, but you can see the sort of cringy Buffett worship they do, because they really are into it. But just because, kind of as a summary, they founded 11 companies within the fund, 35 majority-owned companies, a bunch of minority investments, and then it's a team that they kind of run of 17 at the moment. And here's the team. So kind of sort of mimicking the Berkshire model of you have your kind of internal management and then very decentralized after that. So it would be really, I think, a bet on management and the culture of that management overall. And right now the financials are kind of all out of whack because there's massive expenses from the merger. So the last quarter looks terrible, but that's because a huge portion of the spending was on all the filings and everything to merge. So do you have access to their book value? For the last several years, because I know that's something Buffett would always publish for his. Yeah, so there's not a whole lot of history here because they just went public in April. So a lot of the data we have is for WeCommerce specifically, which is only part of this. So I don't have a whole lot on anything prior to now, but I'm sure you could find a decent amount from their fund filings, which I just haven't had a chance to get into. But I was really drawn to kind of Andrew Wilkinson, and I listened to their whole annual meeting in this last week, and I found myself not agreeing with everything, but there was a lot of values there that were clear that I would support, and I think it's something that's worth looking at. Is this a great deal at this price? I don't really know. There's more that I would need to see, but I think it's an idea that's worth pursuing, at least in the meantime.
What if you go to the balance sheet? What is the book value right now?
Sure.
Let's say tangible book. Well, they might have a lot of goodwill. So yeah.
I want to say there wasn't a ton of goodwill on when I was looking at the merger filing, but
it's $17 a share.
Yeah, approximately.
Even Berkshire's at a premium now. Do they have an insurance company?
No, as far as I know, no. But they're kind of model that they go after. At least with the Tiny fund, is they'll look for companies that the idea is that they would make their money back within 5 years. That doesn't mean they're necessarily buying it at a 5x, but if they buy something at a 10x multiple and they can grow earnings so that they do end up getting their money back in 5 years, that's kind of their overall sort of motto.
15% compounding.
Yeah, it's kind of their investment thesis is somehow getting to the point where you get your money back on an investment within 5 years. So it's an interesting. It's a very value investing sort of model in what's historically not a very value investing kind of space, which has a lot of software involved and a lot of kind of has kind of a very VC element to it. I suppose you could call it like a non-insurance Berkshire, which is, that's a big that's a very big that's removing the heart of it. But a lot of the same values are there, and it's interesting to see how they've been able to grow from where they were many years ago into where now they're actually public, which wasn't really apparently their initial expectation that this is how they would go public through a merger. But yeah. Anyways, I was looking into it and I realized, oh wow, they just went public, and it kind of sent me down this rabbit hole of listening to some of kind of their management values and targets and goals, and so that's tiny. I don't have a whole lot on the actual financials just because it's so new to be public, that is, and I haven't been a member of their fund, so I'm really only seeing what is already public. But
so
on
do
their
you think
on their website, you could see just a quick overview of some of the companies that they own, but it's a lot of these smaller sort of good amount of e-commerce, but one of their physical products they own actually is AeroPress, like for coffee, I think espresso sort of thing. Metal Lab, another one.
Because with the Pareto principle, where 80% of your money comes from 20%, you'd assume that like some of these are the crown jewels. Have you got deep enough into it to know which ones are the ones that they're excited about?
They talk a lot about AeroPress. I think that one has actually done quite well, which is funny because it's not really it actually is a physical product. But I believe these top four are where a lot have come from, or at least I spend a lot of time talking about Metal Lab, AeroPress, and Dribble. And these are the ones that they majority own, as you can see here. But then minority owned, there's a ton more that aren't shown here.
I have heard of Dribble. That's the only one on the list that I know.
Yeah, I haven't heard a lot of these either, and that's why I'd want to do more from here. But yeah, that's tiny.
But presumably, you're going to get a sum of the parts discount from something like this, right? So if you start adding up the value of each of them, you're going to get. That's probably, I would assume that's part of the thesis at some point. Once you get down to valuing each piece,
right? Yes, I would recommend listening to their annual report meeting and the Q&A. There was a lot of good questions, kind of on multiples, because they got questions like, you want to make money in 5 years, but if your business is trading at 15 times earnings, like, well, that doesn't really line up. How are we really getting that done? And that's where he explained earnings growth within all of the companies, and part of that comes from the nice decentralized approach they take to a lot of these companies, and taking a note out of Berkshire's book, and trying to set up incentives properly. I guess they got to meet with Charlie Munger at some point, and Bill Ackman has also funded a number of ventures with Andrew Wilkinson. So they're on the upwards trend, I guess, in the value space, even though, again, it's not really kind of what we consider traditional value, because it has a lot of that tech element in there too. But interesting nonetheless.
Nice one.
So yeah, I don't know if I have a whole lot more like granular details, but kind of at the higher level, I like the sound of it a lot, and I've, with the amount of stuff I've heard from Andrew Wilkinson. He has a business partner. Someone asked if he has a mini Munger. His business partner, Chris, is his partner. He's their basically their CFO. So he's a lot more into the financials, I guess. Former accountant, if I recall correctly. So not a former attorney, got a former accountant for their version of Munger, I guess. But we don't want to count their chickens before they hatch, because they got 60 years to go before they can call themselves that. But you can see a lot of the parallels with how they're attempting to approach a lot of things.
Yeah, for sure.
So yeah, that's tiny. Not sure if I'll make some big swing into it, because I'm not really looking to buy stocks at this time. But it's something I'm going to keep on my watch list, because I think this will be around for quite some time if what they're saying is true. Anything else on tiny?
No. I don't know. I don't think I could bring myself to buy like somebody who who then picks stocks. Like, I feel like that's kind of what we're trying to do is pick stocks, So it's like I'm not gonna
the stock picker within the stock picker.
Yeah,
I guess that. I will say
It's like
that
buying a
at least
mutual
the way,
fund of funds. Yeah.
because of the way they're because of their size, their universe of opportunities is a lot different than say a Berkshire,
Mm-hmm.
and so they get into a lot of smaller private deals that would be harder for someone like you and I to access right now. So you would get that, but yeah, I hear what you're saying though. Like I'm trying to bet on my own stock picking, not someone else's, which is fair.
I've got a question. So do you know if there's an exit plan, or like they're going to build these companies and then sell them off? Because I would assume there's going to be a permanent discount within the,
So that's where I'd want to know about. That's why I don't understand about the fund structure being now merged with a public company. I'm not sure if there's any return of capital at some point, but I do know that at least when they talk about it, they're trying to hold these companies forever. They don't talk about exit plans really. So if that's any reassurance, but I don't know if there's some weird thing with the fund where they have to return money after a certain period or something, but that's where my research kind of stopped, and I'd like to continue with that. All right, Mike, you're far crisper now. So, would you like? Shall we get into your idea?
Sure thing. Yeah, sorry guys. My whole week is online meetings, and I don't know why it's not cooperating today. So,
it's tired. It needs. This is the weekend.
Don't write me off yet. I'll sort it for next time. Anyway, thanks for having me back on, Jack. It's a lot of fun coming on these shows. So
absolutely
glad to be here. So my pick is PDD Pinduoduo. I just bought a chunk of it. Let's see, in May, I believe. Now, I think that. So I'm just going to focus on one piece of Pinduoduo. I'm going to assume that people know how it works. I'll give you a quick overview of it, but I feel like I found something that I don't think anybody I've read or listened to hasn't found. So this is either me being smart or it's being very stupid. So I don't know which one it is. Maybe you guys can help me sort out this idea. But so I think that PDD is actually a scaled economy shared model in disguise. I think it's up there with Costco and Amazon, those sort of famous Nick Sleep examples.
Picks.
And I will get into why I think that. Sorry, Jack, were you going to say something?
No, I was just saying his famous picks. But yeah, what how so? Just because they have like a large platform to kind of go from there, that sort of thing, or.
Okay, well here I'll start off by explaining how the company works. So it's basically this is sort of the redheaded stepchild of Chinese e-commerce, right? Everyone thinks Baba, JD, and then PDD is kind of this low rent third, right? So what they've done is they've built the C2M model, which is the customer talks directly to the manufacturer and orders directly from the manufacturer, right? So PDD has cut out every single middleman that you can, right? There's no distributors, there's no middlemen, so there's nobody to add margins in between. And then what they do is on top of that, they have this sort of group buying model where they let's say you want to buy something, Jack, and on the site they have two buttons. One is buy one you can buy a box of apples for $5, or you can buy 10 boxes of apples with friends for $3 each, right? And so what they did with WeChat is they allowed just really grab people and bring them onto the site really easily. So you could just get a group of friends and everybody just buys buy 10 boxes of apples, right? And then PDD delivers them, right? So what they've done is they've created sort of they've cut out the middlemen. And they've also added this sort of bulk buying thing, which allows prices to come down even more because the manufacturers are they want to know that they can sell big volumes and then they can get the prices down. That's sort of like Costco. They buy so much that they can get them for low prices, right? So that's the general reason why people like PDD. And then they ended up getting 900 million people on the platform, super fast, just because people were just bringing their friends in and going, okay, let's all just buy stuff together, get it cheap, and like I guess I would compare this with Taobao. Like, do you guys own Alibaba? Are you guys Alibaba fans?
I did at one point, but not anymore. But yeah, go ahead.
Okay, so
I've stayed away from everything Chinese, but that's a different story. Yeah.
Yeah.
Okay, well, just think about the business model here.
Yeah.
Like, rather than
I
China
liked
versus
Alibaba
normal.
though, but yeah.
So like Alibaba's got one of their platforms called Taobao, which is like basically it's super cheap to buy, and there's virtually no like transaction fees and stuff like that, which is the same as PDD. But the Taobao, they've got the people selling on Taobao are essentially middlemen. They're buying from the manufacturer and then reselling on Alibaba. So they have to cut themselves in on that, right? Plus there's an extra layer of distribution. So PDD's cut that out, and they've just cut that guy out, and it just goes straight from the manufacturer, right? And then what they did is they allowed like these manufacturers they trained them on how to advertise, because typically that's where distribution and middlemen come in as they get the product to market, right? But PDD is saying, no, we'll teach you how to do that. So you don't actually need anybody else. You just pay us the advertising fee, and then you just sell right to the customer. We'll provide the distribution, and you just hook into our system. So that's not like, for me, that's a great business right there. That sounds really good to me. But then what they do is, Jack, can I send you something to put on the screen?
Yeah, definitely.
So I want to go through the income statement. So if you can pull up the Q1 income statement there, because I think it has to download. I couldn't link you right to the statement. It's on page 4.
Murat?
Okay, so yeah, that's perfect, just like that. So they got 5.5 billion in revenue in the first quarter. Right off the top, you see the gross profit. The gross margin's like over 70%. They average around 75%, right? And then if we go, so really, high gross margin. Then if you go down to general administrative expenses, look at that line. That is actually the cost to actually run the platform. So they are running ultra lean, right? Their G&A is 2% of revenue. Okay, so just really lean model to start with. And then, okay, so the one I want to focus on is the sales and marketing expense. So see, it's like 2.3 billion, which is a significant chunk of the revenue. So what that is what PDD does is they offer you discounts on top of these super cheap prices already, right? So if you go to, like, have you guys tried Temu? It's the US version of their, like, they built it in the US.
No, I haven't.
So if you, I have.
Okay.
And so what happens is, like, you go on the site, and like this, before Threads, actually, it was the most downloaded app in the last year or something.
Really?
Right?
I didn't even realize that.
And you go on there, and the first thing you see is spin the wheel to get a discount, and you spin it, and you get like, 25% off everything you buy. And so that's PDD just giving you a discount on top of what the manufacturers are charging, right? So they're so super low prices get even lower with PDD throwing money at you. And so everything I was reading, so this is the crux of my point here. So everything I was reading and listening to was saying, this is actually bad. They're going to have to get rid of the discounts. They're going to have to remove these at some point. And then what are they, right? But if they don't just offer everything for free or super cheap, like this kind of crappy business model. But I actually think this is the moat. This is the scaled economy shared, because they still have like over 70% of their revenue available to do whatever they want with. And they're saying, you know what, we're going to take 20% of that, and we're just going to funnel it back at the customer to get the price even lower. Right. So
it's the low cost provider moat really is where you're getting at.
Yeah, it's basically like
that's where the Costco comparison comes
right.
in.
I get it.
Yeah, and so like if you just scroll down to the end to the net income line, it's already there. So 1 point. So they're already making 20. That's about 20% in Q1. They average about 25% net margin last year. That's with all these discounts, right? Yeah. So they're ultra high margin company already. Like, what's Costco's?
13%. They try.
Yeah, I was gonna say around 10. I forget, but yeah,
it's either 11 or 13. But yeah, they that's like their commitment. They will keep that at that same percentage. Yeah,
right. And but
every savings on the customer.
So the thing is, PD doesn't even have to add that because that's Costco covering all their warehouses and their staff and everything. So they don't even have that extra bit of margin. It's just coming straight from the source, right? So the model's even sort of like got cheaper than Costco, I think.
So like roughly making a little over $4 billion US dollars a year is, and then what are you expecting growth rate to be?
Well, if you look at that one right there, that's 58% growth, right? So I'm going with 25% going forward.
Okay.
But the thing is, they have two huge growth arms as well. They've got their grocery arm, which is way lower margin, but the TAM is huge. Like it's, I don't know exactly what it is. I've seen a few numbers, but it's in the trillions, right? And they're already the biggest grocery company in China right now, and it's just like they're just on a rocket up. And then the second one is the US. So like I downloaded Temu just to try it out, and it's like you compare the prices on it versus Amazon, they're way cheaper if you're just buying stuff.
I was going to ask that. Yeah, are they actually the lowest cost provider?
Yeah, they're like easily, and that's even with the shipping.
But it's for like
China.
Groceries and stuff. Like I can buy groceries from Temu or.
Oh no, sorry. Groceries in China, but Temu is the stuff site. It's like AliExpress or something, or Amazon, right?
Yeah.
So you can.
Are there cheaper things out there than Amazon? I've just been only using Amazon.
Yeah, AliExpress is the American version of Alibaba, which is that.
Well, maybe do some investment research and download Temu and see if you can find stuff that's cheaper.
Awesome. Even just for personal use, if it really is cheaper.
I'll write it off. No,
well, I would want to know is, I mean, it's already large, obviously, but how much, if it gets larger, how, if you're, factoring in a 25% growth rate, I'd have to believe there'd be some margin compression or no. Just because, even though they're running lean, like as stuff gets bigger, you're going to have more expenses you run into, or you might have trouble sourcing things at the great price that you might be able to do at a smaller scale. So what about, does that concern you at all?
The thing that more concerns me there is not the size. It's more about a culture shift. If they move away from being, because this guy, like Colin, who originally ran the company and built it, is no longer the CEO. So you've kind of got a Jack Ma situation there. And he was like, this company was notorious for, like, I think somebody died at work. And it was just like they pay really well, but they work them to the bone, right? And so like it's this real culture of efficient, lean, hard work. My fear is the going away from that over time, right, with new management.
Well, maybe not going away from employees dying, but
well, I think well,
I see what you're saying though.
Jack's going soft as a business owner.
Yeah, right.
Exactly.
So what percentage of their revenue is China?
Most of this is China. The US stuff hasn't really started yet. They launched in November, I think. And I think they had 50 million downloads in 4 months or something. So like in the US, you think the US component is more like, Shein or Shine, the clothing company?
Yeah, vaguely. Yeah.
So basically it's this super low cost, like clothing company that's it's gone from 0 to 100 billion, like overnight, because Americans are just like using it like crazy. And so it's kind of like that, but sort of a more generalized retailer. Like sorry, Patrick, the question was about China. So most of this is just the core business right now, but like as the grocery business grows even bigger, Jack, like you're saying, the margins will come down because the grocery margins will only be like 4% or something.
Right.
But the core business should still be functional as that grows and have a huge margin on it.
Why? I think your answer to this question would be they don't have the big infrastructure cost to worry about. But why can't any of the other bigger players try to, crowd them out, like Baba, for example? Is it just because of the massive expenses that they would have to run compared to this one?
That's a good question. Like, this is what I'm trying to think about. I'm trying to I'm actually coming from the angle, like, if I was competing with them, how could I beat them, right? Because like, if you want to beat them, you have to get cheaper than them somehow, right? And I can't see a path, right? And so like, Baba has built Taobao Deals, which is their answer to PDD, and I think they're up to 300 million customers or something. But it's still a long way from 900 million. Basically, like, everybody uses PDD already.
Sure.
And so,
so the question is, sort of thing.
Maybe they just split the pie after a while, but I think Taobao Deals has to get the model right, and then they still have to spend cash flow to discount, right? And I don't know if because I own Baba too, I don't think they're as efficient and lean a company. So I think the overheads that are attached to it are just higher.
I guess that is a reason why they're splitting things too,
Yeah,
so
maybe.
Different management to be ideally a little more efficient, you would think.
So,
Okay.
So just like in general, like what do you have any discomfort of investing in China, or like what would get you past that?
I do have discomfort. And it's the usual one, like the political, like, is this economic war going to get worse? Like, I don't think either country is stupid enough to start a hot war, but I think the economic battle could get more intense over time, which might be a problem. But I cap my China exposure at 20%.
Yeah, that makes sense.
Okay.
And do you have Tencent too?
No, I've just got Baba and this one.
Okay. Now, why did it say that they were headquartered in Dublin, Ireland?
I noticed that, as well.
I don't know the answer to that.
Okay, that was on Jack's page. I saw that.
Yeah, on Ticker it says the company was formerly known as Pinduoduo Inc. and changed its name to PDD Holdings Inc. in February 2023. PDD Holdings Inc. was incorporated in 2015 and is based in Dublin. Is it a tax move?
I think it's a tax move. What wasn't all Apple's money in Ireland for a long time, and then Trump helped bring it back?
But then that begs the question: how do they own, the Chinese holdings? Because that's a whole thing. Only Chinese the ADR things that we've talked about before for other companies. I wonder how they actually own it. If you happen to know, Mike.
I am not good at detail. You're the lawyer. You're the one.
I'm not a securities lawyer. Maybe I should be, but yeah, and that's like a whole different can of worms, just because of the Chinese government involvement. They have a lot of sway, that's for sure.
I guess I just don't. I personally don't believe that the Chinese government is stupid. Like, I think they know that foreign capital coming in is good for the country, and I don't think that they're going to mess with that. That's my belief.
Yeah, and I see that side. For me, it's also just there's no transparency to like the population itself. Like, are they going through an extreme population collapse, right now because of and like, what does that look like in 20 years? And there's all kinds of, it's just like you look over at China and it's just like a gray. There's like you can't see anything
from over here. I suppose, it is obscure.
And that kind of, I don't know. That's what's
that kind of had me concerned as well. It's go ahead.
Oh yeah, I was just saying, like one of the guys that I kind of listened to is Peter Zeihan, and he's a geopolitical person, and he's very much tied to my industry with the fertilizers and chemical production and stuff. And I don't know, it's like China seems like there's some strange stuff going on as far as mainly driven by population, and so like if that happens, it seems like all this other stuff. It's just an unknown to me.
I think there's geopolitical risks with any investment, really. And that's where kind of investing in what is helpful. That was my main concern though with China, was just like information obscurity, like what's real and what's not. Maybe that's unfounded, maybe not, but there are definitely lots of opportunities out there. So
Yeah. I think all that stuff's totally fair. Like people who don't want to invest in China, I totally get it. I'm just looking at this through the lens of what's the best business, and I'm like, this is a phenomenal business. Like it's unbelievable. It's better than everything else I own, right? And I'm like, I got to buy some of it, right? Because it's just so amazing, right? Because
it looks good. Shoot, I think anybody would buy Costco right now at 20. I know PDD's 20 times earnings, and it's going to have higher growth than Costco is what you're saying. But I think anybody here would buy Costco at 20 times earnings,
Oh yeah.
And that's the same way I felt about Alibaba and all that intense, like JD, they all look great. And even Charlie Munger said the same thing. You can just find much better valuations for great businesses in China. It's just, I like the 20% rule though, because.
Yeah, I think I stole that from someone, but I
think I want to say Tom does something like that. I could be putting words in his mouth, but I think our very own Tom does that. It has like a fixed cap on it, just because you got to, you want to draw the line somewhere, and that kind of goes for any concentration of holdings. Doesn't not necessarily from one country, but what's the maximum you would make on an initial bet on a company, just to. Keep yourself sane and safe. That you're not overexposed. Seems like a fair thing to do.
Can I just throw? I just want to throw the risk here. Like the one risk that, like, based on what you were asking me for, Jag, is like, I think the risk is something like an Amazon bundle. Like if Alibaba figured out a big bundle to put together and say, if you're a member of Taobao Deals, you get all these additional perks, like because they have a huge entertainment arm and they have all this other stuff. Like they could potentially put together a package that PDD can't compete with. Like there's no evidence that that's happening, but I was like trying to think, okay, maybe there's value adds somewhere else where people could undercut them that way.
Yeah, it'd be hard to beat the efficiency though at scale, because they you're competing at someone who already has the market share. So to get in there, you'd have to somehow undercut them, which is very hard without scale. But to get the scale, you need some market share, but they already have it, so it's it's very hard to get started. Maybe you're right that the bigger one is the culture shift of management, if there's anything like that. And if they no longer remain as lean as they have been, that could be a major problem as they scale. Maybe that's just it. It's not even outside competition. It's just internal dissolution or whatever you want to call it.
Yeah, that's where I've gotten to. If you think of other ones, let me know.
At first glance, it seems about right, but yeah. Okay. Well, anything else then on PDD? An interesting thesis.
Answer that question about China if you want to highlight it.
What is it? The most recent one?
Yeah.
Yeah. Does Patrick have reservations about investing internationally in general? Or is it more specific to China and their lack of transparency? I guess that's referring to your cap.
Yeah.
Not your cap, but yeah, go ahead.
Actually, I said I said China, but really he's right here. I think I own 0 international stocks. I don't even like investing in Canada. Tiny. I feel that too. But that's just that's. Is he from Canada?
Yeah.
Oh, okay.
Okay. I don't invest in Canada.
It's more just what I know, though. It's not like a political thing. I think if there was a product that was very present here, but that it happened to be headquartered internationally, I would be fine investing in it. Like an example that would be, I think Garmin was one I almost bought if it would have dropped further, but it was always like. It just never got to like my margin of safety level, and it's a watch company in Switzerland, but that sort of thing. So
yeah, but they have big operations here, right?
Yeah, and I could see myself doing something like Toyota or one of the ones that you can see here. That's
fair
fine.
enough.
Yeah.
Well, Alibaba does have AliExpress.
Yeah.
That counts. Does the website count?
Well, also, I don't own any. Well, I guess I do own some I don't know, website, that sort of things, tech, fin stuff. I stay away from that too.
You want the real stuff. You want to hold it.
Real. I want to be able to hold the product.
You want to visit it. Visit it.
Yeah. But
All right, fair
that's
enough.
just a circle of competency competency thing, less a more than anything.
And ease of access and everything to information, especially, and getting the vibe, if you will, that is important. Luis with a kind super chat of $3.50. What is that? Is this a reference?
Yeah. About tree fitty, yeah.
Okay, so then
we're running out of time, right?
Yeah, Patrick, I don't know if you want to do a quick pitch on your other one. You can't tease us, and then I'm gonna let you go.
No, I'm gonna be very quick. Then it's a basket. American chemical fertilizer companies. I feel like it's a commodity. I have a bunch of notes. I'll just give you the high level stuff. I can't speak too specifically because I actually had a video on one, and then it got a little too close to home as far as where I work, and so it's taken down. But similar to Buffett's Oxybet, right? It's the commodity market that was boom and bust for a long time, but now you have this huge focus on low capex returning. There's a company that I own that said their plan is to return 100% of free cash flow to stockholders. Like everything beyond, if it's not maintenance capex, they're not doing it. Like zero growth. And I think that combined with the international like macro stuff going on, specifically the war in Ukraine, the pipeline that got blown up from Russia to Europe, like natural gas discrepancy in the U.S. versus Europe because of U.S. shale and all that we're like by far the low cost producer compared to any other manufacturer outside, and that it's more low cost producer, up market, plus good capital allocation and low debt, and that's.
So would that be more of like a trade then, or are we talking about like long term hold? Or are you just?
It's a cyclical move.
Yeah.
So, I could see myself selling it, but it would have to be at an attractive. I hate paying taxes, so like it would have to be at a pretty high premium,
Fair.
So, if you look, I sent you a couple graphs. You don't have to pull them up, but U.S. natural gas right now is like $2.60 per MMBTU, and in Europe, if you convert it, it's like $8 per MMBTU. It's Europe's in euro per megawatt hour, but same thing. So that's Henry Hub. That's going to be the U.S. price, and that's going to always be low just because of our natural resources. Like no American elitism or anything like that. Like it's just like that's what we have here. We have almost unlimited with the shale and all that, and then the European natural gas is 25 euro per MMBTU, which translates to about $8. 25 euro per megawatt hour, which translates to like 8. And so basically, like I said, low cost provider is in the US, and the demand is growing, so it's just a supply demand play, but also own low debt, smart capital allocation companies, not the reverse,
Sorry, Patrick, what's the ticker?
So it's a basket, but I really do own a couple of
basket.
them. And I'll give you a few. So CF's one, Mosaic, Nutrients in Canada, which is interesting. But there's one in Australia that's I was hoping to have Tom on here because I wanted to get his opinion on that. I know he's not in Australia, but he's close enough. But anyway, that's it. I just think it's similar to the oil thesis without the downside of the horrors of oil, and how bad it is. These are fertilizers. This is a net good. You would hope, right? And then let's see, one last thing about it. Oh, it's extremely hard. Even if they wanted to do growth and stuff or have competition in the U.S., it's extremely hard because of all of our new environmental permitting regulations to start new chemical plants here. Like, it's crazy. I deal with it every day. The government, there's so much red tape and extra cost to to starting new. Whereas if you're already here and you're grandfathered in a way, it's a big help. So,
well, then you also have Fosagro in Russia. So I think they're the biggest company, right? And they've basically been taken out of the system, right?
Because of the war, yeah.
Yeah.
And I like the nitrogen side more just because of the natural gas discrepancy. But obviously with Mosaic, there's phosphate exposure. But yeah, I like the ammonia side. I think that's easier to grasp. Yeah.
I was looking at natural gas and I thought, oh, how do I play this? Because I think it's probably going to come up at some point, like as a trade. And so it's an interesting idea, like an indirect play on it.
Yeah, don't buy something that doesn't have a lot of decay. That's my advice. Yeah, if you're going to buy a natural gas ETF, but like I thought the same thing. Like I think that the natural gas is going to go up. So like, how do you profit off of that? I think the best way is to own good commodity companies that are going to prosper if the price is realized. Don't go buy natural gas ETFs. I've learned that lesson. The price stays like this. The price goes up and down and stays the same, and you lose like 60%. You're like, what the hell? That's leveraged ETFs or something like that. Don't do that. Don't make that mistake.
I think I have made that mistake.
Yeah.
That's an easy one when you're just starting. That's a very easy one to make. So, okay. All right then.
Anyway, that was quick.
Fertilizers, net gas exposure. Okay, fair enough. Well, great.
You're playing that discrepancy between the U.S. and the rest of the world. Yeah.
Right.
But
cool.
Sorry.
Well, thank you both for coming on. I think this is a fruitful Best Ideas episode. Now, whether it actually bears fruit long term, I don't know. But short term, I thought this was nice. So thanks for coming on.
Thanks, Jack.
Yeah, we'll definitely have to have both of you back on at some point soon. Patrick, I think you're slated for a couple episodes in the near future, so hopefully you still can come. I'm putting pressure on you now, and Mike would love to have you back soon as well. But otherwise, if you've made it this far, please like, comment, subscribe, all that great stuff. It helps the channel out a ton. And be sure to stay tuned for next week and all the other content we're going to have coming out in the near future. We're rolling out some shorts, for example, to help get some more exposure for the channel. And then we'll get some new shows, like midweek shows, in the very near future. So looking forward to that. So stay tuned, subscribe, hit the bell icon so you don't miss future episode notifications. And until next time, everyone.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.